Welcome to the Space Coast Real Estate Show. I am your host, Roofer Rob. Along with me is Jesse Hall from Space Coast Podcast and John Maselli from Movement Mortgage. How's it going, guys?
Going good, going good.
What's up, Rob?
So today we got an awesome show, all dedicated to finances, because in real estate, you will eventually need financing of some sort. And there's so many different types, from residential, commercial, to bond programs. And really, we just decided to take this whole show and just dedicate to every different mortgage instrument out there.
The
so
Mortgage
that way
Show.
Everybody knows.
Mortgage.
So, John, you are the expert. So, I guess let's start with some residential houses, which is, the majority. Everyone's going to have a residential house. Obviously, there's FHA, conventional, VA, but I guess let's just go into the details of all of them, so that way, if anyone has any questions about finances, they can just listen to this show, and we'll have all the answers.
Okay, well, first I want to talk about cash. Some people have
Love cash.
Cash on hand.
Mm-hmm.
So, that being said, is it always wise to take all your cash and put it into equity into a home, which you can't pull out unless you either sell the property or you refinance the property? So, rates being as low as they are, money's cheap, you may want to hold on to your cash. You could probably put it in investments or other instruments that would yield you a bigger return than sitting in a home.
Right.
Yeah, I've always been taught that having a house paid off is a bad thing, because then you have all of that money sitting there, not earning no interest. So it's just sitting there. It's an investment, not earning anything. And as time goes on, money is worth less and less. So if it's just sitting there not earning anything, then you're technically losing.
With the home values, if they're increasing, it is actually a good way to make money. But if the market starts to decline, you really don't have any control over that portion of your funds.
Yeah.
So that's in today's market, it's probably a good thing. In a year, maybe 2 years from now, who knows? You might be losing money.
Yeah, real estate is the only sure investment. The only thing is you don't get to pick when it's time to take the money out. You can take the money out when the market tells you. So it is always sure. More millionaires were made from real estate than anything else, but you don't always get to take the money out when you want it out.
The most earliest way families would convey title, nobility, and even wealth and power was the transfer of land. You look at old, style government and the serfdoms and everything else. You had your nobles, right? And they all had land, and that's what gave you power. That really hasn't changed. Being able to have a little piece of whatever equity, something equitable in your community or whatever else, something that's, not many people can take from you except for like special instances like eminent domain or something else. But it is one of those things that carries through generation to generation. So it's still a good vehicle to let, go from generation to generation. And certainly the ability to put cash into it, like you mentioned, if we're going to stick with cash, you don't want to be cash poor, especially when you get into a house. So you could put 100% of your cash into a home, and you're like, great, it's paid off, I don't have any bills. But it's like, but how are you going to furnish it? How are you going to take care of the lawn? If you have no cash and everything's into the property itself.
What if emergency arises?
Exactly. So now you're house rich, cash poor.
Yep. That's not a great place to be.
Not usually. Unless you just have tons of cash coming in.
Yeah.
So it's probably, I guess, maybe of course, everybody's situation is going to be different, but it does seem like the best is probably a mix of both. Wouldn't you agree?
Yep, absolutely.
I would say, if it were me, to 25, 20 at minimum down. That way you avoid your private mortgage insurance, so no PMI.
Yep.
Okay. And then you're leveraging somebody else's. And if you read anything from Napoleon Hill, Rich Dad Poor Dad, anybody else, leverage other people's money.
Yeah, OPM.
Don't. I mean, because what if there's a fire and all your cash is in that house too? your insurance may reimburse it, but it may take a while. What are you going to do in the interim?
That happened to a friend of
Right.
mine. He was out of his house for well over a year, and so he also had rent and
Yeah.
so
So we know it's a great way to convey wealth. It's a great way to
build wealth.
build wealth. You don't want to always put cash. I mean, unless you know. Well, for instance, and we rewind. There are some properties that you can only pay with cash, right? I mean, these are like total rehabs, not insurable. No bank is going to give you money to, you know what I'm saying? So there are some way, but in that case, you probably have more than what the house is worth so
Yeah.
that you could fix it up and then get a return later on.
Yep.
So there are strategies. But let's just talk about, for instance, the first-time home buyer. Let's start from the beginning. You're 24,
There
you're
you
out
go.
of college, you maybe are engaged, right? Or maybe you have a couple kids, you already started a family. What should they do first? Save money, improve their credit, both at the same time?
Well, the credit is a very important component to getting a mortgage.
Right.
You have to have, in an FHA type of situation, you have to have at least a 580, and if you have between a 580 and 619, there's all kinds of additional hoops you have to jump through.
Right.
You have to have reserves, and the guidelines are very stringent, and also too, you're probably going to have more of a possibly a down payment or
Right. So
things of that nature. So
here's a caveat for those young borrowers. You will need to beg, borrow, steal. You could always ask forgiveness. Due to time, 16 months, you're in and out, whatever it takes. But you got to get that, 3.5, 4 or
Yeah.
5, percent if you want to qualify for conventional or FHA. Right. If you can do conventional, should you, or should you do FHA because you could have more money in your pocket?
if you can do conventional, it's always better to do conventional, especially the first-time home buyer. In a conventional, they have, the home-ready products where you put 3% down. Even in FHA, it's 3.5% down.
Right.
But there are income limits to those programs, so if you make too much money, you don't qualify for that. So,
Well, for everyone out there, what is the difference between conventional and FHA?
well, conventional and FHA are Fannie Mae and Freddie Mac type of loans. So, the FHA is more of a government backed product. So, in an FHA, you have to have 3.5% down. It does have a higher debt to income ratio, and it does have a low down payment, 3.5. So it is a good product for a lot of young folks.
When you talk ratio, and I'm going to use this little portable whiteboard that we have.
Okay.
Because we want to illustrate this, and we're still going to spell it out for those listening, but for those watching, we're going to use some fun whiteboard. What is a good ratio for FHA?
So before we get into that,
Yes.
The debt to income ratio, the things that are determining factors in making a credit decision are debt to income ratio, of course, your income and your credit score. Those are the big things that you want to maximize. So the debt to income ratio is a ratio of how much money you make and then how much money you spend on bills, credit cards, car loans, student loans, those type of things. So in an FHA, we can go up to about 56% debt to income ratio.
And that means if you're taking in, let's just say for easy arithmetic, $1,000 a month.
Yep. And your
Then
bills are $500.
Right. So you can only spend up to $560.
Yep. And that includes all your bills, including the housing bill, which will calculate the mortgage payment into that ratio.
So 56 for FHA. So this is where we're at so far.
Yep. And then and there's two ratios. There's the housing ratio. That's what you pay for housing alone. And then there's what's called your back end ratio, which is all your bills. So the back end ratio is the more prominent number that mortgage companies use to make credit decisions. So the back end is 56 on FHA, and on conventional loans it's 50. So if you're above 50, the underwriter on a conventional loan, the underwriter is going to say, "Whoop, they're over 50. We're going to have to do something here."
So if you're trying to get a mortgage for say $2,000 a month, you have to be making at least 4,000.
Correct.
Right. So
And
that's
that-
easy arithmetic for people
Well,
to
it's
remember.
not just a mortgage for 2,000 months, all your bills. So if you have a
Right.
car payment for 500, so it'd be 1,500 in bills, 500 in car.
Right. But
So
but,
the ratio has to be under 50.
but all your expenditures have to be at less than 50%, 50 or less.
Correct.
Okay.
For a conventional product.
Cool.
Yep.
So I hope that makes sense. And that, again,
Yes.
conventional, they're not going through Freddie and Fannie, or they are.
They are.
Okay. And then for people who don't know, Freddie Mac and Fannie Mae, they're not really called Fannie Mae, Freddie Mac.
Yeah.
You know, these are acronyms that they phonetically, altered. So these are government programs, and these are pretty much, would you say, like these are government arms that subsidize housing?
Yeah, they subsidize housing.
Right. Okay.
That's a good way to put it.
hmm So FHA, but FHA, for instance, is a product of HUD.
Yep, and that the government guarantees these loans. So
Mm.
it's a guarantee is so if you default on the loan, the
Mhm.
loan's going to be paid by the government so that the investors don't lose out.
Right. When you say investors,
Yeah.
the federal government.
Yep.
So
Wow.
they do help, and the government actually gets involved pretty heavily. And this is, I don't want to get off topic too much, but they also offer, the same HUD will offer like Section 8 and all kinds of other different
Yeah.
housing programs as well. So FHA is just a loan option.
Yeah, so even during the pandemic, the FHA has been buying mortgage-backed security bonds to stabilize the bond market,
Mm-hmm.
and it's actually the reason why rates have been so historically low
Right.
recently. So
And then VA, isn't VA kind of like does that fall under kind of like FHA?
yeah,
Just-
VA is also VA and USDA are FHA, VA, and USDA are all they call them govies.
Right.
They're government
Now,
backed
are they all?
products.
But the USDA, that's a U.S. I don't want to say dairy association. It's U.S. What is that? Help me out.
It's Department of Agriculture.
Department. Okay, so I was close, right? It was like farming. I'm
Yeah.
like thinking of like it's not dairy, but I think it
that-
covers dairy.
Is that like a bond program, USDA?
No, USDA is also so you have the VA loan, and the VA loan is a zero down payment product offered to veterans.
Mm-hmm.
USDA is another 0% government option that is offered to anyone. However, it has to be in a certain tract of land, so it has to be
Right.
in a area that's classified rural.
And we could discover that. So
Yeah.
find an agent to help you find those USDA qualified properties, and if there's one in your area and you could qualify for not both the loan and the property qualifies for the loan as well, then you can take advantage of that product.
There are USDA tracks in Brevard and also
Yeah.
like in Sebastian and parts of Vero and that I know of,
Mhm.
and I'm sure there's
Wow,
a
that's
lot of
awesome.
other places in Florida.
Now, is that a HUD? That's the Department of Agriculture.
Yep.
So that has nothing to do with HUD.
Well-
so HUD has the FHA and the USDA has the USDA loan.
Yep, that's
Okay.
right.
What about VA? Is that a Department of Defense thing, a military thing, or is that also HUD?
Yeah, that's Veterans Administration.
Okay.
They but it kind of all falls under the same government umbrella,
Sure.
but there's all
Sure.
different.
But one's
different-
offered from one part of the government.
Yep.
Yeah. Okay.
And for the VA, it's any veteran.
Well, any veteran that has entitlement. So, if you had a honorable discharge and you have a DD 214 that indicates that you have entitlement,
Mhm.
so I have access to the VA portal and I would go there and check your entitlement. If you have entitlement available, then you're eligible for a VA loan, and
Mhm.
it's really the best product outside of USDA.
And they can only have one loan at a time, veteran VA loans?
No, there's some different guidelines. There are some circumstances where they could have a second home. Like if they were deployed to a different area, but they intended to go back, that kind of thing.
Right.
Possibly, it's an underwriter decision if that applies or not. And that goes back to, they're going to pull up all the VA guidelines and determine if that situation is warranted.
Right. And we'll get to the VA, and we'll wrap this up very nicely for everybody. If we can talk about more of the entry-level programs. Is there a first-time home buyer? Is there an overall program in general nationwide, or is it specific to regions?
So they have conventional, like I was saying before, they have the Home Ready, which is a nationwide product.
That sounds great.
The Home Ready is a 3% down first-time home buyer program. You do have to take a first-time home buyer course offered by several online entities, but it's a good product. There are income limits based on how many household members there are, and
now is that a bond? Is that a second mortgage?
Nope, that's just a straight up conventional mortgage.
Okay.
First lien.
Okay, and there's no
there's no secondary.
Is there any assistance for closing costs, prepaids, down payments?
Well, I mean, you could do seller concessions, so the seller could contribute to closing costs.
Yeah, and hold that thought, because we're going to come up with creative ways to manage these things.
Yep.
So what other first-time home buyer options are there?
So there's the Home Ready, there's the Home Possible, which is a first-time home buyer renovation loan.
Oh, cool.
So it has the same. It has basically the same components as the Home Ready, except for you can do a renovation loan.
Well, that's pretty awesome.
Yeah.
So could you do it on a flip, or is it more along the lines
Yes.
if you lived in the house and you want to do some renovations?
No, that's more of a, well, you could they do have a Home Possible renovation refinance, but you can also do it on a purchase. Say a house needed a roof, and we call Rob up, say, hey, this house needs a roof. It's first-time home buyers. We're going to do we need a estimate
And
on a
what a
roof.
first-time home buyer, how long do they have to not own a home to be a first-time home buyer?
3 years.
3 years.
So you could have owned a home
4
in
years ago.
the same state or in another state?
Any state.
Really?
Yeah.
So this program can pretty much exist throughout your whole lifetime of purchasing property, because most people on average will move every 5-6 years.
So say your
so
company took you to another region and you rented for 2-3 years.
Right.
If you rented for longer than 3 years, you're back into the first-time home buyer
Excellent.
scenario.
Is there any drawbacks?
The drawbacks are, there can be, if you exceed that first-time home buyer, if you exceed that income limit, and there can be a recapture tax associated with it, but it's very rare. And it's a 9-year purchase, so if you sell it prior to 9 years, and if you sell it prior to 9 years and you qualify for this recapture tax, you could have a tax bill to the government. There's a lot of requirements that make you liable for that tax. I don't have them all in front of me.
So is there like a maximum number that the government loans can go up to, like a maximum amount?
Well, I mean, these are conventional loans, so they're in the conforming limits of 540 right now.
No, I mean like a total loan amount. Like
540, yeah.
So $540,000.
Yep.
So if you bought something over $540,000, it'd be considered a jumbo.
Jumbo loan, yes.
Oh, okay.
Okay, we'll get into those, because
Yep.
I wouldn't mind. I'm not sure how much you're prepared for, like a little commercial or something else, but maybe you can just get into like a little commercial loans, because I really wanted to get into like construction loans and a lot of the fun stuff.
Yep.
This again is for some of those new people who are just learning to discover things. I don't want to put all the fancy stuff in the first part of the show. So we want to work accordingly and make sense of this. So for the young people, again, I think that Home First, whatever, I think that's a great product. I prefer conventional. as a real estate agent, and if I'm representing you, I'm going to say get the conventional over the FHA, because it just gives a connotation for that seller. If they get a cash offer and a conventional loan and then an FHA loan and then a VA loan, people,
When I start,
they just come with a little bit of
Yeah.
a stigma. So
When
I
I
would
s-
say always get conventional.
when I start a loan application, I fill in the loan type as conventional every time,
Right.
and I try to qualify people for a conventional product. And then if they can't, then I'll move them off to an FHA or something, that fits better.
Sure.
But conventional is always the first option if possible.
And why? Because they're flexible. Because they're better
Well,
rates. Because
The main reason is because in an FHA type of loan, that PMI is attached to the loan forever.
yes.
The only way to get
So
out
bad.
from under that is to refinance. So a lot of people will refinance into conventional once they qualify for it to get
Exactly.
rid of that PMI. In a FHA, the PMI is going to always be there, and
Mhm.
then on a conventional, after you buy pay the principal down to an 80% loan to value, then it'll go away.
Oh.
So
And it magically disappears.
Yeah.
Or do you have to write a letter or
Oh
call
yeah,
somebody?
you have to. They'll keep
Well,
charging you as
There you go,
long
that's
as
what I'm saying,
they'll
they
keep
know.
charging you until you.
no, it magically goes away in basically in 9 to 11 years. But
like that.
if you say in 5 years your house has appreciated considerably, you can get an appraisal done
Mhm.
and show that now that you're at an 80% LTV, and
Right.
then you have to submit some
And
paperwork.
I want to put this too. So LTV, you have I'm just going to write a line 1 to 100. So this is the value of the home.
Yep, loan to value
So
ratio.
as soon as if you're over 80%, you're paying PMI,
Yep,
just like that.
property
okay.
and mortgage insurance.
Now, when you get lower, then
pay your
everything
principal down.
else here, this falls off,
Yep.
and magically you're just paying the life of the loan
Now you're-
and principal and
Yeah.
interest, and not the insurance.
Yeah, now your payment just went down by usually around 150 bucks.
Yeah, 100. So that's wise. Always, always, always. And if you're listening now, but I'm already in a loan, I'm happy. I don't know why I'm listening to you guys. Have you considered dropping your PMI? Look it up. If you're still paying it, and in the last 3-4 years here, especially locally here in Florida, Central Florida area, you've appreciated by 6,
lot.
7, in some products and markets around town. Even 10, 11%. Some of these condos, some of these, single family homes in Vieira and so forth. Just boom, boom, boom.
Double digits.
You just gained all that equity doing nothing in your house. Go talk to your lender again.
Get
Yeah.
that
'Cause-
PMI off there.
Because if you don't need it, why pay it?
Yeah, why pay it?
You know what I'm saying? Like that is a tax. Like no one
Yep.
volunteers to pay that.
Yeah. I mean, other
So
than
stop paying it.
yeah, it's very. I mean, other than protecting the lender, it's unnecessary. I mean, for the borrower,
It's a tax.
yeah, it is a tax, and getting rid of it as soon as possible is more
Paramount
money in
to
your it's more
Yeah.
money in your pocket.
$1,200 a year or more.
Yeah, that's a lot.
Yeah.
So I think that's a good intro. Do we have any other questions? Anybody regarding anybody out there? We are gonna move into now. Do we want to do like a second home, or do we want to do like a construction loan? Because what would happen if, for instance, you're carrying a loan, and now you want to borrow again and get into like an investment property or a second home?
Yep.
Is that easy? What do you need to do? Is that a different loan type?
So it's not a different loan type. Primarily in second homes and investment properties, it's almost always going to be a conventional.
Right. Because they're not going to give you an FHA for anything but your primary.
Yeah, that's correct.
Right. And what about VA? Can you? I mean, I know Rob was asking that. I think Rob, do you qualify for
Yeah.
VA?
Yeah, absolutely.
Thank you for your service.
Yeah.
So, can you hold an FHA and get a second FHA?
So in certain circumstances, you can.
Oh, okay.
In all of these products.
Right. Okay. Certain circumstances.
Yeah. like a VA loan,
Yeah.
I know that you can have a second home, but and have second entitlement. And actually, this year, well, in 2020, they removed the VA loan limit, so there is no limit.
I heard
Oh,
that.
that's
And so here's the biggest question when this news broke. Like, what do you mean? I could borrow more than I think the cap was like 350 or
Yeah.
something. So everything was capped, and you could only buy a product up to that amount. But now they removed that cap. So now I have VA clients going. So Jesse can. I mean, before even when it was like 350, they're like, well, can I take 175 in this property, 175 in this property? I'm like, I know where you're going with that. Trust me, I wanted to have as many houses as possible. It keeps me busy. But we found out that it wasn't likely.
No, and don't forget your debt to income ratio. So it all
Right.
boils down to what you can afford. So,
Mhm.
you know, and a lot of veterans have, you know, especially like I've seen this. He was a submarine captain.
Mm-hmm.
He had so much retirement income. I was like, wow, you're
set.
doing well.
I know some submariners too from the Navy. Yeah.
Yeah.
So if a VA home was to go into foreclosure, would they be able to get another VA loan, and how long?
Well, so then there's when you default on a government product like that, it's very difficult to get another one. But after time, I think, you know, after some years, you may requalify for your entitlement. But
Mhm.
don't do that if you can.
Never default, please.
Do not default.
So
Please.
like
rob the paper boy, okay?
Yeah.
Rob the paper boy, but don't don't miss your payment.
Yeah, the
So my brother, he's my ex-brother-in-law, but he's pretty much my still family. I call him my brother. He did a bond program when he bought his house.
Yeah.
Mhm.
Those are typically funded. Are those still funded, or are they still doing those? Or
They are doing those. A lot of that fund has been diverted because of COVID.
Mhm.
It's been diverted to eviction prevention and foreclosure assistance.
Right.
Because of COVID.
Yeah, they put a moratorium
Yeah.
on, and of course, you know, now the state's this episode. So, you know, being that we're just coming through the springtime, we're celebrating. I don't want to say celebrating, but we're recognizing the year since
Yeah.
COVID actually emerged. And I remember just the headlines in the last couple of weeks was like, you know, this was a time when everything started shutting down. Disney, everything was just
Yep.
like closed, and
crazy
cruise
time.
ships stopped, and so we're, you know, coming around, you know, the bend or around the sun again, and we're visiting the same time of year when all this happened. Now,
Yeah.
of course, things have changed entirely. I don't really see in Florida why anybody couldn't work. Looks like everybody has pretty much returned. Even the people who were sent home have still been telecommuting from home. So we're unique, I guess, in Florida
Yep.
because not every state has the blessings that we have, and so I'm not sure why we would still need that protection. I think that moratorium probably won't be extended, and that's going to be a topic for another day.
Yep.
oh,
because-
yeah, that's going
because
to be a big mess.
But that
because-
being said,
right.
though, I have heard that some of these programs are going to begin being funded again soon.
Okay.
So they may be a viable option. I personally steer folks away from this product because there's a
And please, we need to hear this, and all the other
Yeah,
lenders
yeah.
are going to be like,
shoot us straight.
please tell people the bond
Yeah.
program is not what you want.
yeah. The reason why is because you're locked into this property for at least
I'm going to write these down.
7 years. And if you sell, you know, most people sell in 5 years, especially young folks. They're moving around, and if their income increases beyond the income limit, which is highly likely for, you know, especially in this area with engineers coming in, and you know, they start out right out of college and
Right.
they purchase, but then their income, you know, goes up rapidly
Right.
in a few short years, and if their job takes them elsewhere, they can be implicated in that recapture tax. They can,
Recapture, right?
Yeah.
So they have to pay the bond back,
yep,
right? And I know it was up to like $15,000 for Brevard County because
Yeah.
we were
And-
hardest hit, and this was a program.
Yeah, the HHF, the hardest hit fund.
Yeah,
Yeah,
so
pretty much covered all closing costs. I worked with a couple people that did them, and it worked out really good for them. So
I'm going to put
And-
15,000, but I
that
think it
was a long
corrected to
time ago.
I think it corrected to 7,500
It was
now.
7,500. Yep.
So and that becomes
Well, so there's a couple of different programs. There's a grant.
Right.
There's a three.
and a
and-
grant is free money.
There's a 3% and 4% grant,
Mhm.
which is and it goes away over time. That's what that time period is. So some of them are 5 years, some of them are 7 years. It on the 15,000, it was $5,000 a year. So if you lived in the house for 2 years, then you
So they would prorate it.
yeah.
Yeah. So if you didn't live the whole 5 years there,
Right.
then you had to
I'm-
pay whatever difference.
Yeah, I
is
meant
that.
it was $3,000 a year for 5 years is 15,000.
Right. So, and I'm just going to illustrate this. So, to recap, the bond program. Let me just get that squared away on the screen. 5 to 7 year minimum. Okay. Otherwise, you pay the penalty. Again, if your income increases, you may no longer qualify. Is that correct?
Well,
Is there a way that you can get price yourself out of it because your wage increases or anything else?
Well, no. What happens if you go above the the maximum income limit
Right.
and you sell the property within 9 years
Mhm.
and you make a profit on that, the
Right.
government will take some of that profit back.
Ah,
Wow.
that's a
That-
big one.
That's the recapture.
Yeah, the recapture.
I thought on the bond program it was recorded like a second mortgage. So when you sold the property, it got paid back.
and that's what I was going to mention as well, right?
So those are the grants, but the bond program is
okay.
there is a second option where you get a second mortgage on.
So, and then of course, depending on how much you borrowed or what kind of grant you got, you had to pay it back if you breached that minimum staying in that particular home, because this was for you to get into home.
Yeah.
Not to make an investment, not to buy a second home. I mean,
Yeah,
this
these
was-
are primary.
Yeah, this is your
residence.
primary residence only, and you even have to go like 90 days of school, and
Yep.
yeah. So it's a lot of hoops. It's a lot of limits on your home now. You have pretty much a lien that says you can't sell it
Yeah.
unless you're going to pay it back. That's
Yeah.
so you lose a little bit of freedom,
Yeah.
and these are the sticky things that most lenders would say if
Yeah.
you could avoid this, just avoid it. You know,
Yeah.
I mean, this is really to help
Especially for
people
young
who have
people
no other option.
who are developing their life strategy.
Right.
You know, it could be a problem later down the road. But in certain circumstances, if you're starting a family and you plan to not go
Right.
anywhere, and your whole life and livelihood and family structure is here, it could make sense.
You just got to make sure to stay put.
Yep.
For that duration.
Yep.
Great. So that's the pros and cons of that
Yeah,
bond program. And like you said, money was taken away. Now it's being reallocated. Talk to your lender. See what's available in your area,
Yeah.
because it's not always available for everywhere.
Yeah,
I know
and
Brevard
the-
County had something specific.
And these are generalizations, I mean, if I had somebody that was interested in this program, I'd have all of the guidelines pulled out in front of me, and I'd be
Right.
asking them a ton of questions.
Exactly. Moving on, did we cover the second home if you already have an existing mortgage?
Nope, not
Okay.
yet. So, we're going to talk about the conventional products and as
Okay.
far as second homes and investment properties go.
Perfect.
So, on a second home is considered a vacation home or a home where you have to. So the guidelines on a second home is you can't have two houses in the same area that are considered your primary residence in the second home. I think the minimum is I think it's 100-mile difference.
Oh.
And you have to show that you're going to be working at your primary residence. Like some people say, oh, I'm going to take my current home that I own. It's going to be my second home, and now I'm going to go buy my primary residence on the beach in Florida. And so the underwriter will say, whoa, where's this guy working at? Where's these people working? Are they working at the up north house, or are they working at the Florida house?
Roger.
And then they'll have to show some kind of pay stubs or offer letter. If they're moving, they have to provide some kind of information or documentation that shows they're going to be working
Mm-hmm.
near their primary residence, and that's for homestead reasons
Right,
and also too the amount down payment changes based on. So a second home, you're looking at putting it, on a primary residence. On a conventional, you can go as low as 5% down.
Right.
On a second home, you can go as low as 10% down. On an investment
Oh, wow.
property, usually it's 85.
I thought it was much more.
Yeah, I thought so too.
Okay, so we're learning.
The investment property is going to be 20% down or greater.
And I'm sorry to
So primary is 5%.
yeah,
Second home is 10% down.
and you call that vacation?
Vacation / second home.
Mm-hmm. 10%. Okay.
Yep. And investment is going to be a minimum of 20% down.
Now, when they say investment, is that a buy and hold? Is that a fix and flip?
So an investment property would be a rental property.
Let me just write that down.
Yeah.
Okay, so
So
specifically for the use of
Yeah.
renting out.
a fix and flip is a completely different product.
Right.
Yeah. So a fix and flip is what's called non-conforming. These are all conforming loans.
All right.
Meaning they fall under the conventional guidelines.
Right. No, nothing weird. Nothing.
Right.
No surprises. Nothing.
Yeah.
Nothing constraining. So there you have it. 5% primary is your minimum. You have 10% for vacation second.
Yep.
So how many? Like, what if I wanted to have in my own name a primary, a second home, and then like 3
You can have
rentals?
up to 10 of these loans.
I could have 10
Wow,
of these
that's awesome.
loans.
If you can afford it, yes.
10
If your debt to
loan
income
max.
ratio supports 10 of these investment products, then, well, I mean,
Right.
your primary, your second home, and 8 of the investment products, then yes, you can.
Curious. Okay, so we're learning.
So,
Absolutely.
so, and now in that debt to income ratio
Right.
calculation, those investment properties, if you're renting them out and you're making an income, now that income can be calculated into your debt to income ratio, making it better.
That's what I was going to say. Like if I'm getting into a home, it's not going to be an expense. I'm not paying that mortgage. Somebody else is, right?
Yeah.
Yeah.
But to qualify that income, we would have to have a investment appraisal done.
Right.
So when you go to make so say you have a primary, a second home, and one investment. If you're going to go make that second investment and you're making a profit on that first investment, we would have to do a investment appraisal to verify that the property is worth what it is. It's making the proper amount of revenue, and
Right.
and then of course you'd have to show a lease
Oh, of course.
to make sure that
Right.
you've got a tenant, and then vacancy factors are
that's-
locked in, are
That's easy.
calculated in.
Yeah,
all
that makes sense for any lender to want to make sure that it is.
Just verify.
Yeah.
Yep.
Make sure that property is doing what you say it's going to do.
Yep.
Okay. So that's a 10 loan max. I had no idea. That's perfect. So, and then we could get into other things. I mean, because I have so many questions. As far as where to go. Like, well, what if I want to get a loan overseas, like in the Bahamas? Anyway, we're gonna get into the international market and stuff like that on another episode. What about construction or even rehab loans?
Okay, so renovation products, we have the first time home buyer home possible renovation that we spoke of. We have VA renovation loans.
Oh,
Yes.
Wow. What about?
So that just came out recently.
Yeah, the
how
VA
does that work?
renovation loan is it's a renovation loan, but they cap the renovation to $30,000. So in a renovation that can get eaten up pretty quickly, right, Rob?
Yeah, absolutely. 30 grand's not. I mean, it's not very much. I
That's-
mean, it is
That's
enough.
flooring, paint, maybe some countertops.
Yeah.
Yeah, I mean, it's enough to do a decent job in a
Or
smaller size
it's-
house.
Right.
it's geared to a house that probably might need a new roof and some
I mean, I would.
some minor upgrades, or if it had a good roof and the kitchen is dated, you can.
Well, Rob probably knows this answer, more than best of us. What is the value? Like, say for say $30,000 in renovations. Like, is there a metric if you feel like this home after repair value is like 300,000? What would you expect to put into it, and like as a good margin? Like, is it like 30%? Would it be like 90 grand? What
so you're looking that you want to be into the house for no more than 75%
okay
of what it's worth, ARV, after repair value.
Right.
You don't want to be into it for more than that. So
Okay.
you take that number, the 75%,
Mm-hmm.
and then subtract the rehab, and then
Right.
that's what you need to buy it for.
There you go.
So because the rehab, it could be
So
huge.
do you want to borrow the full value then?
Well, it depends on if you're going to flip. If you're just flipping the house,
Right, flipping.
then you just take the money, put it into it, and get it going.
Right.
Well, on a VA loan, you can go up to 100% of the value. So if you took the repaired value and minus the 30, that's what you want to buy the house for in a
So
VA loan
would the-
scenario.
would the VA give you 100% of the after repair value?
Right, the
Yeah.
ARV.
Oh, wow, nice.
Yeah.
Because that's what we're trying to
Yeah,
get
That's
across.
huge.
If I'm able to get a VA loan and find like my neighbor's property, which I know
It's nasty.
they just maybe they were hoarders, maybe they just maybe one person got sick and ill and the other person was a caretaker. There was no person really there to keep it up because they were both just one's sick, one's exhausted from taking care of the other. So there's things happen, right? And then of course now perhaps maybe they passed away or went to a retirement home, and now the property's in disrepair, right? You're not going to get for retail. But if I went to the VA, like, listen, I know what it's worth because I'm next door, and I know that I could put it, I get some neighbors to rally together. My kids want to help me repair it, and then you would offer it to that bank or whatever, or maybe the family or whatever, maybe in probate, and then you get that property. But then how do you convince the bank that it's worth a certain amount? I mean, didn't you have to do like an appraisal, like a normal?
Yep. So all of these renovation
Mhm.
products will have an as repaired appraisal done. So
Mhm.
basically, they're going to appraise the property as is,
Okay.
and then, as long as it's not an over improvement, like if you wanted to take that house that conformed with the rest of the neighborhood and then turn it into the only mansion on the street,
Mhm.
it's not going to conform with the rest
Not
of
gonna work.
so if it cost $50,000 to bring it back to conforming with the rest of the neighborhood, so they're going to do an appraisal
Right.
as is and then add the 50,000 onto it.
And if they know it's a rehab, and if they know it's a rehab, there really is no because I know the VA is pretty tough, even just
Yeah.
regularly with normal retail property as far as the
their
appraising
inspections continue.
and the inspections are
serious.
tough.
Yeah.
Yeah,
Well,
and
Here's the process
Yeah.
in a renovation
Okay.
loan. So when you apply for the loan, you're saying I'm going to do a renovation. So
Right.
what I'm going to need for you is all the normal documents that you would qualify for. But I would also need a certified general contractor to break down exactly what you're doing with drawings and how much the material is going to cost and how much the labor is going to cost, and that has to be separated. And then so they'll take the as-is appraisal, and then they'll go over all of the renovation documentation
right.
and look at the improvements and make sure it's conforming with the rest of the neighborhood. And then basically you just add that number on to that's the loan amount.
That'd be a great help because I know there's some disabled vets out there who, they can't really hold a job. Maybe it's PTSD. Maybe they're amputee. Maybe there's
that's a
something
good
else
deal.
going on. Maybe they got some knees from being a paratrooper. And they just can't do regular work. If they
Well, usually their disability will provide them a good compensation. And,
Right.
And also
So-
too, I can gross their income up because they don't pay taxes on it. So it's if they're making $5,000 a month, it's like making $6,500 a month.
right,
Oh, wow.
exactly.
That's
So I can
awesome.
gross their debt, and work that into their debt to income
Man,
ratio.
That's perfect, John. But we do owe some time to our great sponsors who make the show happen. Again, this is Jesse Hall. You're listening to the Space Coast Real Estate Show, and we're gonna have some more topics as we
here
come
on
right
the
back.
Space Coast Podcast.
That's right, Space Coast Podcast. Space Coast Podcast.
The Mortgage Show.
Yeah, we are gonna return right after these short messages. Take care.
Roofer Rob here with RRCA Roofing and Reconstruction Contractors of America. We are an insurance restoration specialist. What is that, and how is that important? Well, let me tell you, in Florida, what we find is most homeowners sign up for their insurance, pay a premium, and then when they file a claim, the insurance company tries to pay them a minimum. Not cool. We specialize in using the software that the insurance companies use and holding them accountable to the policy that they sold you and ensuring that you get a premium roof for your premium. Check out rooferrob.com and download my free report on the Florida roofing secrets that the insurance companies don't want you to know. In that report, I'll give you all of the secrets on how you can be successful and get a premium roof for the premium that you spend. Or you can call me direct at 321-368-1881.
Hi, Michelle Carpenter with Inspiring Home Staging and Redesign. We are Brevard County's premier home staging team, founded in 2013. You may ask, why stage your home or listing in a seller's market? Well, let me tell you, staged homes not only sell for 86% faster, but for 17% higher price. We have services for vacant, occupied, and luxury home staging. The definition of home staging is the professional service of preparing homes for sale in a way to appeal to potential buyers that generates a higher sale price. Our mission is faith, family, and community. Your home is your biggest investment, so stage yours today to get a higher price. Contact the team that inspires at 321-806-6543.
Hi, my name is John Maselli with Movement Mortgage, Beachside, Indy Atlantic. Movement Mortgage is a faith-based organization, and our mission statement is as follows. We exist to love and value people by leading a movement of change in industries, corporate culture, and communities. To me, this mirrors my own business philosophy. My goal is to help people finance purchases or refinance current properties stress-free and at great terms. Help people and everything else follows. By the way, if you have equity tied up in your house, the only way to get it out is to refinance. Pull that equity out and pay off high-interest debt or build a pool. My office is at 225 Fifth Ave, Suite 4, Indy Atlantic. Call me anytime at 321-248-6245 or visit my website, loanapply.approved.com for more information or apply to qualify for a mortgage today.
You're listening to Space Coast Podcast, home of the greatest podcasts on the Space Coast. If you're interested in becoming a sponsor or having your own show, email us at spacecoastpodcast@hotmail.com.
Space Coast Podcast.
Talk hard!
Welcome back to the Space Coast Real Estate Show. This segment is brought to you by Movement Mortgage. We were talking before the break pretty much about all the different mortgages and different vessels, I guess, to
Vessels.
purchase your house.
Purchase vessels.
So, I guess now we need to get into the fun stuff, like fix and flips and investments and construction. What do you got for us?
So we have a full line of brokered products. So our brokered products are loan products that we do not do internally, but we broker them out to specialists, people who specialize in certain types of mortgages, loan products. So those types of products are, they're land loans, fix and flip type loans, investment type loans that are not conforming. We spoke about conforming loans, but
Right.
they call them non-QM, not non-qualifying mortgages.
And what does that mean? Like a bank won't insure it, or
So the non-qualifying mortgages cannot be sold on the secondary market. So they're, they have primary investors that, it's their investment strategy to fund these types of loans. But
so are they private, or is this what they call hard money?
there's private and hard money. There's a lot of different sources for these brokered products.
Okay.
But, we have what's called a broker matrix, and so I pull up my broker matrix and I look at the scenario, and it says, if somebody's looking for a land loan, I look at my chart and I said, okay, there's Advantial, they do it, and there's Normandy, they do it, and so I'll have, 2 brokered products that I can put side by side and see what makes the most sense for the borrower if they wanted to buy a plot of land to eventually build on. So the lot loans are kind of funny because there's a big difference between whether you're buying the land to hold or you're buying the land to build on in the near term future. So,
Is the interest rate going to vary depending on what you want to do with the land?
Yes. So if you want to, buy and hold a piece of land, it could be risky for the lender because there's really not much for them to secure the loan with. So in a typical loan scenario, the house secures the loan. So if you default, you have the value.
They just repossess the home.
Yeah.
Well, it's not like the land's going to walk away.
The land's not going to walk away. That's true.
There's still a title and a deed attached. So if you default, but who wants to now what? I have to improve it or I have to dump it. You know. So it's not something that'd be ideal for any investor or any private lender to now be holding. Like, now I'm stuck with this.
Yep. Now I have to repossess this piece of dirt.
Damn piece of dirt, piece of paper, a piece of paper about a piece of dirt.
That's right.
That's funny.
So how long would they have to build? Like, what's the time frame?
Yeah, these must expire. I mean, there's not a 30-year loan like that, right?
No, and also, these loan terms are much shorter, like 5 years. But they want it, they're going to vet your plan out. So, if you're planning on building in the near term, you're going to have blueprints and specs and
so what
contractors.
What about that VA rehab loan? Is that mature in 30 years or?
No, the rehab loan is just a regular 30-year loan.
It is?
Yeah.
Wow. So you get into a property, fix it up all you want.
Yep.
Not have any other down payments, 100% paid for.
Yep.
You pay it, you show, and then of course you got to probably have to show the VA, like, look, I did it all. So.
And you get to live in it.
And then you get to live in it.
So fancy.
That's amazing. Well,
it's great.
God bless our troops, and you know what, they deserve that. And I'm so
Amen.
glad there's something like that because now they could improve homes.
Yep.
With the help of the VA, bettering their community, lifting that community up, getting rid of that derelict, neglected property.
It's a win-win for everybody.
That's great. I like
and
that.
living comfortable for them.
Exactly. I like that a lot.
I like that a lot
how
too.
hard is it to find one of these non-qualifying or non-conforming?
How hard is to find the product? It's not hard at all. You call me up.
Okay.
Or go to loanapply.approved.com.
Say that again.
Loanapply.approved.com.
Loan apply approve. I'll write that down for everybody who's watching who maybe have us muted. Loanapplyapprove.com. Now, John, I mean, do they have like lots of money, or do they put restrictions, or is it just like a regular like loan to value? Like they're not going to give you more than what you could earn, or are they going to?
Well, these broker products even have stricter loan to value and debt to income ratio guidelines. So like a lot of these products, they won't go, like the actual debt to income ratios on a conventional loan is 39% housing. I mean, we learned this in real estate school, 39% housing, 42% back end. But there's some leeway there. You can go up to 50 on a conventional and up to 56 on a.
And this is another thing I don't get. Once again, loanapplyapprove.com. Get your products from Mr. John Michelli. Now, John, here's just a hypothetical. Like, why won't banks loan you money so you could rehab like higher end homes? Meaning, I don't earn enough to get into that high-end home, but I know how to repair it.
it'd be like a fix, like a
why
flip.
can't I borrow it just so I could repair it, and then we could both share the profit? I mean, I think it would be really cool, because even if I defaulted, now
If you
now
if you
you got a brand
qualify
new
for one of these
home.
loans, like a fix
Right.
and flip, I mean, you're going to be paying them.
Right.
You're going to make some money, but they're going to make some money too. So
Exactly.
And the fix and flips, there's products that go up to 3 million. There are products
Mhm.
that there's a lot
Look.
of them have minimum loan amounts of 100,000. Most of the non-QM stuff, they don't like the little loans.
Right.
So they're going for big numbers so they can make big interest,
Well, of course.
and then
Yeah.
the terms are short, so the rates are much higher. You get a 30-year term, you're going to have a lower rate, but if you got a 5-year term, they got to make their money, so your rate's going to be much higher, 9-10%.
Mm-hmm. And is it the same kind of percentage? I mean, how do I phrase this? It's the same kind of
Like, what are the terms? Is it like a 12-month
So-
balloon?
No, for
Do you have
instance,
prepayment penalties?
So what they'll do is they'll, like on a fix and flip. Let's just say you're planning on a 9-month renovation.
mhm.
So you'd get a 1-year product,
Mhm.
and so that way you got a little bit of leeway. There is usually on those products there's a prepayment penalty. So if you pay it off before the year is up.
Mhm.
So, you got to really know, because you can get a 6-month, a year, a 2-year, a 3-year. But just remember that, the rates might seem high, but since the term's only a year or 2 years, your interest payment is not going to be
Well, yeah, private
Yeah, and it's
private loans
and it's
are
not a
little more.
compounding interest,
right.
right? It's just a flat rate,
Just a flat rate,
right? So if it's 15% on 100,000,
Yeah.
it's 115, not 115 or whatever it is, 15% every year compounding,
And then for those types of loans, you have to show debt service. You have to show that you can afford the payments throughout the build period. So there's
Mhm.
going to be debt service calculations.
So
in
they
there.
do the money in draws?
They do the money in draws usually. Yep.
Mm-hmm. Well, it sounds like there's all kinds of options.
Like, what
Yeah.
kind of interest rates? Like, ballpark?
Yeah, like I said, 7 to 10.
Which private lenders are going to charge 10 to...
On a
to
5-year,
15,
it's
so
going to be a
that's
little
really good.
less, 6 or 7.
Oh, see, that's not bad at all.
Yeah,
No, not at all.
it's not bad. They make money. You get to flip it and fix it and flip it, and usually on that flip, you'll pull a good check in.
Yeah,
Absolutely.
and with
So they make their money.
with
you
somebody
make your
else's money, right?
Yep.
Yeah, because listen, these investors, they don't want to do all the flipping all
Yeah.
the time. Sometimes they just want you to do the work. Here, and then
Yeah.
and then if you can make,
Yeah.
and of course most of them won't get in bed with you unless they like the property, like the project,
And
like
you've got
what
skin
you have
in
to
the
say,
game.
right? And
So-
then you have the
Most
money
of
to
these-
improve it.
most of these products, the loan to value is like, 75%. You
Right.
got to have at least
So-
25% down, or
Exactly. So that gets you into the property itself.
Yeah.
But you still need that capital to improve it.
Yeah.
Whether it needs a new roof or HVAC systems, so you got to be prepared to come
Yeah.
above that loan amount out of pocket.
And the more you
Right.
can put in, so if your debt to income ratio, say, is like, instead of 75, it's 60,
Mhm.
you'll get better terms.
Yeah.
You'll get a longer period. You can get all
Sure.
the money you need to do the renovation. So
Mhm.
if you got skin in the game and you got some cash and you want to do a fix and flip, those are good products to get you the rest of the way to you can sell it and get your money back.
What about new construction? If you wanted to build a brand new home,
So we have construction loans that are also brokered out, and those have been a little bit scarce during the COVID time because there's just so much what I like to call vanilla deals. There's so much conventional FHA, VHA refis and purchases. It's just it's our volume quadrupled
wow,
since this time last year.
That's amazing.
outstanding.
I love to hear that, and I love that most people have been refinancing. So good job for everybody who's had some equity. You know, it's a great time to still get some of that equity out. Again, get those high interest credit cards
Yeah.
paid down. Get those student loans, medical bills, anything that you could free up that'll leave.
I really enjoy
Yeah.
doing those loans. Like I
Yeah.
take people from a 30-year product and put them into a 15, and they're only paying like and pay off all their bills,
Right.
and they're only paying like $100 more, and it's saving them like
awesome.
$700-800 a month.
Exactly.
Yeah, it's great.
Amazing stuff. Well, thanks so much, John. Our hour is
Yep.
up already,
Wow.
guys.
I could keep talking about this for a week.
We may need a part 2 for all those listening. Send us
Yeah.
your input. Again, you can find us on Facebook, Space Coast Real Estate Show. You can see it there. I'll put it up real quick. We do have a Facebook page, so go visit the Space Coast Real Estate Show on Facebook. Leave us comments. Have some fun with us. If you want to do a private message and learn more about John and what he can do for you, or if you just want to jump right online and go to
LoanApplyApproved.com.
loanapplyapprove.com. And again, Movement Mortgage, thanks so much, John. And
All
of
my
course,
information is on that page, and all my contact information. You can call me directly, and I would like to get into a non-QM discussion sometime soon on all these products.
we may have to
Oh,
do that, and we may also need Rob to help us as well, because I know you have some people in that space, some hard money and other lenders who can
Talk,
contribute.
absolutely.
So we may just make a special show just for investment style loans
Yeah.
and
Yeah,
what it
that-
looks like to be
It's a great idea, yeah.
a flipper.
Yep.
So with that being said, Rob, you want to take us out?
It's been a fantastic show, and everyone have a great week. I definitely appreciate Movement Mortgage and John for all that great information. We'll see you next week.
That's it, guys. Take care.
Thank you.